There is a moment, visible only in hindsight, when the newspaper says the crash began. A date, a headline, a number on a chart that appears to have fallen off a cliff overnight. That date is not when the crash began. It is when the crowd was allowed to find out. Before every major financial collapse in modern history, there is a quieter period, weeks, months, sometimes longer, during which something moves beneath the surface. Not with drama, not with announcements, without a single headline that the public will remember. Wealth moves. Not all of it, not obviously, but enough. And it moves in one direction, away from paper claims, away from leverage exposure, away from the assets that are about to reprice and toward cash, toward hard assets, toward exits that will not be available once the doors close. By the time the crowd sees the crash, the transfer has already begun. That is not a conspiracy. It is a structural feature of how financial systems communicate information unevenly and always at a delay. This video is not about who caused the crash. It is about the mechanism that precedes it. The quiet repositioning that happens when some actors in the system begin reading signals the public cannot yet see. By the end, you will understand three things: what the signal actually looks like before anyone calls it a crisis, who moved, and why. And why the crowd, no matter how smart, almost always receives the information last. One of these will permanently change how you read the next period of calm. Most people understand crashes as events. A bank fails, a market drops, a government announces emergency measures. The event is visible, datable, dramatic. That framing is wrong, or at least incomplete. A crash is not an event. It is the public revelation of a process that was already underway. The drop in prices is not the beginning of wealth destruction. It is the moment the destruction becomes visible to everyone simultaneously. And by then, the most important decisions have already been made. This matters because the crowd's response to a crash is rational, but it is rational to the wrong timeline. People begin protecting themselves when they see the crisis confirmed. But the confirmation is not the beginning. It is close to the end of the transfer phase. Think of it this way. A market at its peak is not a static thing. It is a system of competing beliefs about future value. When enough actors begin revising their beliefs downward quietly, without announcement, they start to reduce exposure. They raise cash. They decline to roll over positions. They stop buying what they were buying last year. None of this looks like a crisis yet. Prices are still high, the news is still calm, the assets are still moving, but the direction has already shifted. This is the mechanism hiding beneath the visible event. In 2007, a number of large institutional investors began reducing their exposure to mortgage-backed securities. These were products that had been among the most attractive instruments of the preceding years, high-rated, high-yield, apparently safe. They were still being sold to institutional and retail buyers well into 2007. They were still receiving top credit ratings, but the exit had already started. This was not invisible. The signals were there in credit spreads that began widening before prices fell, in the cost of insuring certain debt positions that started climbing while the official narrative remained confident, in small movements in interbank lending that a specialist could read but a newspaper could not explain in a headline. The exits were not locked. They were just quieter than the entrance. By September 2008, when Lehman Brothers collapsed and the crisis became official, the repositioning was not beginning. For many large actors, it was already substantially complete. The crash that the public experienced as sudden had been priced by some participants over the course of the previous year, not with certainty, not as a prediction, but as a probability that made reduced exposure rational long before the announcement made it obvious. The crowd arrived at the conclusion last, not because they were unintelligent, because they were reading the wrong signals, the ones the system makes loud while the relevant signals were quieter, slower, and designed for a different kind of attention. Argentina, 2001. This is the case where the mechanism becomes almost physically visible. In the months before the government announced the Corralito, the freeze on bank withdrawals that trapped ordinary depositors inside accounts they could no longer access capital had already been leaving. Not all at once, not dramatically, but steadily, in the way that only becomes obvious when you look backward. Dollars were already moving out of the banking system. Wealthier depositors, businesses with foreign connections, Anyone with access to hard currency accounts abroad had been converting and moving funds for months. The mechanism was not secret. It operated through entirely legal channels, but it operated at different speeds for different actors, and the speed depended almost entirely on access to information, to foreign accounts, to dollar liquidity, to advisors who were reading the fiscal signals. When the corralito was announced in December of that year, it did not catch everyone equally. Those who had moved early were outside the freeze. Those who had waited either because they lacked the access, the information, or the trust in their own reading of the signals were inside it. Same country, same banking system, same crisis. Completely different position. The crash did not create that difference. The months before, the crash did. This is the part most histories leave out. The asymmetry in a financial crisis is almost never about who is smart and who is not. It is about who has access to early signals and who receives confirmation late. The two groups experienced the same event on a different timeline, and a difference of weeks, sometimes days, can determine whether someone is a buyer or a seller when prices finally move. In 1929, in the weeks before the stock market collapse that is remembered as the beginning of the Great Depression, margin buying by ordinary investors was still expanding. The market appeared strong. The mood was confident. And yet, reports of elevated institutional selling were already circulating among specialists. The market was being distributed shares moving from early holders into the hands of late buyers, who would hold them through the decline. The mechanism is not unique to one era or one country. It appears repeatedly across documented collapses, a period of visible calm during which the composition of who holds what is quietly changing. The crowd buys confidence. The informed reduce exposure. The price has not moved yet, but the ownership has. By the time the price moves, the transfer is already substantially complete. The crash, in this sense, does not create the asymmetry. It reveals it. What does the early signal actually look like? It does not look like a crisis. That is the point. If it looked like a crisis, it would already be priced. It looks like the cost of insuring against a loss becoming slightly more expensive in a market that most people never watch. It looks like a widening gap between what very short-term lending costs and what slightly longer-term lending costs. A spread that usually stays narrow and is considered boring until it is not. It looks like corporate insiders, officers, directors, significant shareholders filing routine regulatory disclosures about stock sales. It looks like a currency that has stayed stable for years, beginning to weaken slightly, in a move that analysts describe as a technical correction. None of these look, on any individual day, like the beginning of a collapse. That is what makes them signal rather than noise. A signal that everyone recognized as a signal would already be acted upon, and therefore neutralized. The signals that precede collapses are the ones that require interpretation across time, the ones that only become obvious when connected to each other in a pattern that the crowd, receiving information in daily fragments, is structurally unlikely to see. The crowd is not failing to see a crisis. The crowd is failing to read a sequence. The playbook here is not a prediction, it is a lens. The question to ask before a crisis is announced is not whether the assets you hold are fundamentally sound. That question is almost always answered yes when the asset is popular and prices are high. The question is, who else holds this? At what cost basis? Under what liquidity constraints? And what happens to their behavior if the price moves 5% in the wrong direction? When the answer to that question reveals a structure where large, leveraged, or constrained holders would be forced to sell simultaneously, creating a cascade rather than an orderly correction. The asset is not just expensive, it is fragile, and fragility does not become visible until stress tests it. The people who moved early in 2007, in 1929, in Buenos Aires in 2001, were not uniformly genius. Many of them were wrong about specifics and correct about structure. They did not know the exact timing. They read the composition of the holder base, they read the cost of protection, they read the credit signals, and they made a different calculation than the crowd, not because they had better information about the future, but because they had more relevant information about the present. The crowd knows the price. The early mover knows who is holding it and why. There is a phrase that circulates after every major crash. It is a version of "nobody saw this coming." It is almost never accurate. People saw it. The mechanism was running. The signals were present. What is true is that the people who saw it were not the ones with the loudest voice in the period before the crash. The loudest voices in the calm before a collapse are almost always attached to the most exposed positions. Confidence is louder than caution when prices are rising. This is not cynicism. It is a structural feature. If you hold a large position in an asset and you want to exit quietly, you do not announce that you are selling. You reduce exposure gradually, systematically, without commentary. The announcement comes later or not at all. The public reads the position changes in regulatory filings that arrive weeks after the fact, in quarterly reports that are published after the quarter is over, in price movements that are attributed to other causes at the time they occur. By the time the mechanism becomes legible to everyone, the exits are not what they were. Which brings us to the question this video has been building toward. What is a crash structurally? It is not a destruction of wealth. Wealth is rarely destroyed in a financial collapse. What collapses is the price of claims. But the underlying capacity to produce the land, the equipment, the skills, the relationships, these persist through the decline. What changes is who owns them. A crash forces a transfer of ownership from distressed sellers to patient buyers, from the leveraged to the liquid, from those who waited for confirmation to those who were already positioned to receive the asset when panic makes the price unrecognizable. This is the mechanism the crowd never sees in real time. It is visible only when the prices have already moved. The person standing outside the system liquid, unlevered, with a clear reading of who holds what is not, waiting for the crash. They are waiting for the crowd to become a seller. The crash is not a surprise to the mechanism. It is the mechanism's final step. A crash does not announce itself. It is announced to the crowd. That is the difference. By the time the announcement arrives, two groups exist. One has already repositioned. One is reading the news and calculating damage. The transfer is not completed by the crash. The crash is how the crowd discovers the transfer was already underway. If this video changed how you see the calm before a crisis, there is one more mechanism you need to understand. It is already on your screen. The warning sign people miss before banks freeze withdrawals. The crowd does not know this pattern exists. You will. System Failure Playbooks. We study the collapses. You get the playbook. Subscribe.